You have money sitting in a savings account that you know should be invested. It's been sitting there for, honestly, be real with yourself, maybe a year, maybe longer. And every few months, you open a brokerage account or you look at your old one that has $200 in it from that one time you tried to start and you go to buy something and then you freeze because there are literally thousands of options and you don't know if you need one fund or 20. You don't know what expense ratio actually means in dollars. You don't know if you need bonds yet or if that's only for old people. You don't know if you're supposed to buy Vanguard or Fidelity or Schwab or something else entirely. And the more you read, the more people seem to disagree. So you close the tab again. The money stays in the savings account, and a little piece of you feels bad about it, quietly, for another few months until the cycle repeats. I'm going to fix this today. Not with a comprehensive guide to everything you'll ever need to know about investing, with 3 funds. 3. That's the whole portfolio, and I'm going to explain not just what they are, but why 3 is the number that actually makes sense. Why people who've been investing for decades, managing billions, with every tool and every data source imaginable, often come back to this specific structure, because when something that sounds too simple turns out to be optimal, there's always a real reason, and the reason is worth understanding. My name is Max, and I want to help you learn how to make your money work more for you in your life. This channel is about financial clarity that actually unsticks people. Not more information piled on top of confusion, but the kind of understanding that makes the right decision feel obvious. Subscribe if you want that. Let's get into it. Okay, the belief that's been freezing you. The belief is this: investing well requires sophisticated understanding, careful fund selection across multiple categories, active monitoring, and ongoing adjustment. A good portfolio is a complex portfolio. The more you diversify, the more funds, the more sectors, the more variety, the better protected you are, and the better your returns will be. And if you're a beginner, you should probably wait until you understand it better before committing real money. This belief is so pervasive and so well-intentioned that it has kept more people out of the market than any market crash or financial crisis ever has, because it makes starting feel like a prerequisite knowledge test you haven't passed yet. And the test, it turns out, never ends. There's always one more concept to understand, one more variable to learn about, one more debate to follow. The complexity doesn't resolve, it expands. And the money stays in the savings account. Here's the overlooked truth. The research is unambiguous that simpler portfolios, over long time horizons, outperform more complex ones. Not because simple is lucky, because complexity introduces costs, management fees, transaction fees, tax drag from frequent rebalancing, and because complexity introduces behavioral risk. The more moving parts your portfolio has, the more opportunities you have to make a bad decision about one of them. The 3-fund portfolio eliminates most of those opportunities. It gives you nothing to tinker with, and tinkering in investing is almost always expensive. Here's the analogy. Think about the difference between a Swiss Army knife and a chef's knife. The Swiss Army knife has 17 tools. It's impressive to look at. It seems like it should be capable of more. But when you actually need to chop something, when you're in the kitchen doing the real work, the chef's knife is better. Single blade, well balanced, designed for one job done perfectly. The Swiss Army knife's versatility is mostly theoretical. In practice, you keep reaching for the chef's knife. The 3-fund portfolio is the chef's knife, designed for one job, building long-term wealth through diversified low-cost index investing, and doing that job better than any 17-tool alternative. But here's where it gets really interesting, because there's a specific reason why having fewer options actually makes the investing experience better, and it's documented in a surprising body of research. Psychologist Barry Schwartz conducted a famous study involving jam. Shoppers at a grocery store encountered either 6 varieties of jam or 24 varieties. The 24 variety display attracted more initial attention, but the 6 variety display produced 10 times more actual purchases. The paradox of choice, having too many options, doesn't improve decision making, it produces paralysis. And paralysis means you don't buy, which means you don't invest, which means the compounding never starts. Columbia Business School professor Sheena Iyengar later applied this research specifically to 401k participation and found that for every 10 additional fund options a company added to its 401k plan, participation rates dropped by approximately 2%. More options, fewer investors. The investment industry has consistently used complexity as a feature. More choices feels like more value, when the actual effect on the investor population is the opposite of what they need. The three-fund portfolio is a direct response to this reality. It's not a starter portfolio you'll eventually graduate from into something more sophisticated. It's a terminal portfolio. It's what you hold indefinitely, while the compounding works. So, the three funds, with the framework behind each one. The first fund is a total U.S. stock market index fund. This is the engine. When people talk about the market, this is what they mean, or close to it. A total U.S. market fund doesn't pick winners. It doesn't predict which companies will outperform next year. It owns essentially all of them. Thousands of companies, from the largest technology giants to small businesses that most people have never heard of, weighted by their market value. When the U.S. economy grows, you grow with it. When a particular sector struggles, the other sectors that are doing well absorb the impact. You never have a concentrated bet on any single outcome because you own all of them. The historical return of the U.S. total stock market over the long run, measured across decades, not individual years, has averaged roughly 10% annually before inflation, or approximately 7% after adjusting for inflation. That's not a guarantee. There are bad years. There are bad decades historically. But over 30-year periods, the total U.S. market has never produced a negative return, not once in the historical record. The first fund is the bet that the U.S. economy will be worth more in 30 years than it is today. That's a bet most people are comfortable making, and it's the only bet you actually need. Now you might be thinking, but what about diversifying internationally? What about not being 100% in the U.S.? And that brings us to fund number 2. The second fund is a total international stock market index fund. This gives you exposure to thousands of companies outside the United States, developed markets like Europe, Japan, Australia, South Korea, and Canada, plus emerging markets like China, India, Brazil, and Mexico. Why does this matter? 2 reasons. First, the U.S. represents roughly 60% of global stock market capitalization. Owning only U.S. stocks means your entire portfolio is dependent on one country, continuing to dominate global markets indefinitely. History suggests no single country does that forever. Second, international and U.S. markets don't always move together in the same direction at the same time. They have relatively low correlation, which means that combining them produces a smoother, more stable ride than either one alone. The split between U.S. and international is the main decision the 3-fund portfolio asks you to make. A common starting point is 60% to 70% U.S. and 30% to 40% international. Some investors go as high as 80% U.S. Some go 50-50. The honest answer is that the specific split matters less than the fact that you're in both. You're not making a prediction about which country or region outperforms over the next decade. You're structuring your portfolio so you don't need to make that prediction. Whatever happens globally, you capture it. The third fund is a total bond market index fund. Bonds are the stabilizer. They don't grow as fast as stocks. They're not supposed to. Their job is to reduce the volatility of your portfolio, to smooth out the ride, to give you something that holds value when stocks are falling, and to provide the psychological stability that keeps you from making the worst decision in investing, selling your equity funds during a downturn out of fear. A 20% drop in a portfolio that's 70% stocks and 30% bonds feels very different from a 20% drop in a portfolio that's 100% stocks. The bonds cushion the fall, and cushioning the fall keeps you in the game. And staying in the game is the whole thing. How much of your portfolio should be in bonds? There's no one-size-fits-all answer. But here's a useful framework. If you're under 35 and your time horizon is 25 or more years. Something like 10% to 20% in bonds gives you stability without sacrificing too much long-term growth. If you're in your 40s and early retirement is on the horizon, 20% to 30% in bonds makes more sense. If you're within 10 years of needing to draw from the portfolio, 30% to 40% starts to look prudent. The bond allocation is your adjustment dial. The one thing you might change over time as your situation changes. Everything else stays. That's the 3-fund portfolio: U.S. total market, international total market, bond market, in proportions appropriate for your age and timeline. Done. Now let me show you what this portfolio actually produces. Not in vague terms, but in specific real numbers that connect the simplicity to the outcome. You're 29 years old. You invest $750 a month in a 3-fund portfolio, 65% U.S. total market, 25% international, 10% bonds, with a blended average annual return of approximately 7.5%, accounting for the bond allocation's drag on the pure equity return. Over 35 years, to age 64, $750 a month at 7.5% becomes approximately $1.34 million. Your total personal contributions across those 35 years, $315,000. The portfolio added roughly $1.025 million on top. 3 funds, $750 a month, a 7.5% blended return. And the compounding did more than 3 times the work you did. Now let's see what happens if you increase contributions over time. As your income grows through the career stages, rather than keeping them flat at $750 forever. Year 1 to 10, $750 a month. Year 11 to 20, $1,100 a month, reflecting a couple of raises and promotions. Year 21 to 35, $1,500 a month, reflecting peak earnings years. Running those numbers at 7.5% across the staggered contribution schedule, you cross $2.1 million at age 64. Not from exceptional income, not from perfect stock picking, from a 3-fund portfolio running on increasing contributions across a 35-year career. And the expense ratio on these funds, for Vanguard, Fidelity, or Schwab equivalents, you're looking at 0.03% to 0.10% per year across the 3 funds combined. On a $500,000 portfolio, that's $150 to $500 per year in fees. Compare that to the average actively managed fund at 0.75% to 1.0%, $3,750 to $5,000 per year on the same portfolio. The fee savings compound just as powerfully as returns do. Over 35 years, the difference in fees paid between a 0.05% 3-fund portfolio and a 0.85% actively managed alternative is, on a $1 million ending portfolio, somewhere around $200,000 in additional wealth you kept instead of paying to fund managers who, in 92% of cases over 15 years, underperformed the index anyway. The 3-fund portfolio doesn't just simplify investing, it optimizes it. Simplicity here isn't a beginner's compromise. It's the financially superior structure. Now let me talk about who you become in the process of holding this portfolio through its full arc, because this is the part that beginner investing content almost always skips. The experience of owning a 3-fund portfolio, through real market volatility, through the 2020 crash and recovery, through 2022's bear market, through whatever comes next, builds a specific kind of investor that no amount of reading can produce. You learn in a felt and permanent way that markets drop and markets recover. You learn that the news cycle around a market downturn is almost perfectly inversely correlated with the actual quality of the opportunity in the downturn. You learn that your 3-fund portfolio, by virtue of owning everything, always recovers along with the market because it is the market. You don't have to hope your individual stocks bounce back. The market bounces back. And you own the market. That experiential knowledge, that bone-deep comfort with volatility, is one of the most financially valuable things you can develop because it means you won't sell at the bottom. And not selling at the bottom is statistically more important than almost any other decision an investor makes. Studies by investment firm Dalbar have consistently found that the average equity fund investor earns roughly 2 to 3 percentage points less per year than the fund itself returns, because they buy after rallies and sell after drops, missing the best days by being out of the market. The 3-fund portfolio, held with genuine conviction built through understanding, closes that gap. You stay invested, and staying invested is the whole game. Here's how having a real, growing 3-fund portfolio changes the actual moments of your life. 4 scenarios where the foundation changes everything. Your employer offers a 401k with a confusing list of options, and you're not sure what to pick. Person A, no investing framework, no confidence in fund selection, picks the default, which is often a target date fund with a high expense ratio. Or worse, they don't enroll at all because the choices are overwhelming. Person B, who understands the 3-fund philosophy, scans the fund options, identifies the total U.S. market fund, the international fund, and the bond fund with the lowest expense ratios, and builds their 401k allocation around those 3. The difference in fee burden over 30 years is potentially $150,000 or more. The market drops 35% in a global panic. Person A, individual stocks or actively managed funds with no clear framework, is calculating their losses on specific companies and wondering which are going to recover. The uncertainty is excruciating. Person B, total market index across 3 funds, isn't calculating individual losses. They know they own the whole market. They know the whole market has always recovered. They don't even check the portfolio that week. They redirect a bonus toward additional purchases at the discount price. The behavioral advantage of the simple portfolio is real, and it's worth money. You change jobs and your new employer has a different 401k platform. Person A faces the fund selection problem fresh every time, and it never gets easier. Person B applies the same 3-fund framework immediately. Total U.S. market, lowest expense ratio. International, lowest expense ratio. Bonds, lowest expense ratio. Done in 20 minutes. The framework is portable. It works at Vanguard, at Fidelity, at Schwab, in a 401k, in a Roth IRA, in a taxable brokerage account. The simplicity of 3 categories means you can implement it correctly in any account without starting over. You hit 45 and realize you've been in the 3-fund portfolio for 15 years. Your portfolio is at $340,000. You want to adjust your allocation slightly. More bonds maybe, as retirement approaches. Person B makes one change. Increase the bond fund percentage from 15% to 25% through a simple rebalance. That's the only adjustment needed. Person A, who has a 12-fund portfolio accumulated over the years, has to rethink the whole thing to make a comparable change. Simplicity is not just easier to start. It's easier to maintain, easier to adjust, easier to understand at every stage. Here's the career dimension, because the 3-fund portfolio isn't just a financial product. It's a confidence builder. There's something specific that happens when you understand your investments, when you can answer the question, what are you invested in, with clarity and conviction rather than vague discomfort. It changes how you engage with your employer's compensation package. It changes how you think about what salary you actually need versus what portion of lifestyle your portfolio can eventually provide. It changes how you approach conversations about retirement, about timeline, about what you're actually building. The financial literacy that comes from deeply understanding even a simple 3-fund portfolio is a form of professional development that most people never invest in. And it produces returns in the form of better decisions about when to take career risks, how to think about the value of equity compensation, when to negotiate and when to walk away, that are hard to quantify but are absolutely real. Now, the warning. Because the 3-fund portfolio has one specific failure mode that I want to name clearly. The failure mode is abandonment under pressure, not because the portfolio stops working, because it stops feeling like enough. You'll read about someone who made enormous returns on a speculative investment. You'll see a particular sector or stock getting extraordinary press. You'll meet someone at a dinner party who's very confident about a particular thesis, and the 3-fund portfolio will suddenly feel boring, generic, like you're missing something. Here's the number that puts that feeling in perspective. A portfolio that earns 7.5% consistently over 30 years produces dramatically more wealth than a portfolio that earns 12% in good years but loses 25% in bad years and sees its holders sell out of panic during downturns and miss the recovery. The average investor who chases performance earns, as Dalbar has documented repeatedly, roughly 4% to 5% per year, even in periods when the market returned 7% to 9%. The 3-fund portfolio, held without intervention, captures the market return. That's the deal. And that deal over 30 years is better than almost anything else available to an ordinary investor. The solution to the "this feels too boring" problem isn't to make the portfolio more exciting. It's to remember what boring is producing. Check the compound interest calculator. Look at what $750 a month at 7.5% produces over 35 years. Remember that you own thousands of companies across the entire global economy, and that every day that global economy is producing, inventing, growing, and you are capturing a piece of all of it automatically at essentially no cost. That's not boring. That's extraordinary. It just doesn't have the emotional texture of something exciting, and that's entirely the point. And here's the close. The 3-fund portfolio is the answer to the question that kept you frozen. Not because it's the simplest thing you could do, though it is. Because it's the thing that actually works, that the research consistently supports, that the world's most sophisticated investors keep returning to when they strip away the noise. Total U.S. market, total international bond market, 3 funds, 1 framework. Indefinitely. You don't need more options. You need the right 3. You have them now. Open the account. Transfer the money. Buy the 3 funds in proportions that fit your timeline. Set the automatic monthly contribution. And then, this is the most important part, leave it alone. You've been overthinking something that has a 3-part answer. Now you have it. Go use it.